The seminar will be addressed the impact of 2017 Tax Cuts and Jobs Act on the municipal bond market. Our speakers for the workshop include Stephanie Lum and Scott Beal. Stephanie Lum is the Vice President of the Public Finance for Raymond James and Associates. Ms. Lum covers the entire Northeast region with a focus on New Jersey municipalities. Ms. Lum is also a registered security representative with Series 7, 53, and 63 license. Scott Beal joined Acacia in 2009 and is responsible for providing technical and analytical support for government entities. Ms. Beal has extensive experience in developing new financial models that analyze benefits and the implications of financial alternatives. I would like to thank our speakers for being here today.
The Tax Cuts and Jobs Act of 2017 had the following impacts on the municipal bond market. Number one, and most importantly for us and investors and issuers, was the elimination of the use of tax-exempt advancer fundings. We're going to get into that, what that means for you guys going forward, and strategies to continue to advance or refund your bonds without this tool. Additionally, it eliminated the use of tax credit bonds by municipal issuers. It lowered the corporate tax rate from 35% to 21%. That's particularly important for certain municipal bond investors, including banks and insurance companies. It capped the state and local tax deduction at $10,000, which also has an effect on retail and retail-related investors of municipal bonds. And then finally, it eliminated the corporate alternative minimum tax. 2018 has been sort of a let's figure this out moment for both issuers and investors. Everyone's sort of trying to figure out what the new world means post-tax reform. So we're just going to try to talk through what's happened in the market, what you guys can do to refund your bonds, and then also strategies going forward on your new money transactions. So page 3 just talks about the current market. I forgot to check the internet about whether or not the Fed raised rates today. They did, okay. So for once, the market projections were correct. If you see in this blue box, we anticipated on Monday like a 98% chance that the Fed would raise rates today to between 2 and 2.25%. Basically, what this has meant is that the Fed is continuing to anticipate inflation going forward. There's positive job growth, but wages have not grown at the same speed as inflation and job growth. We've seen the short end of the market, as seen on the bottom chart. The short end of the market is moving with what the Fed has said. So short end of the market rates are going up. Long end of the market, as you can see from the dark blue line and the light blue line, that has not moved as much. So from bond market people's view, basically bad news is going to move yields down. Good news should move yields up. In the year 2018, a lot of stuff has happened. We've had major issues with tariffs and trade, just a lot of headlines that in a quote-unquote normal market would send rates all over the place. For some reason this year, it's been relatively stable. We haven't seen dramatic moves in MMD, which is the market indice that we use to price your bonds. It's just been, seemingly immune to both good and bad news. This is in addition to the tariff tussle, as my desk calls it. There's also an seemingly endless growth in Treasury issuance. The federal government is needing to issue more debt to fund its everyday expenses. And every time a Treasury issue comes to market, it's larger than the time before. The market thus far has eaten that up without a problem. The rates have not gone up. I would say if we were having this conference 2 weeks ago, I would have continued this thought, the market's behaving normally, everything is calm. I think within the last 2 weeks, there's been a little bit of a pushback from investors of both treasuries and munis. They're not sure where long-term rates are going to go in the future. they're not sure if they want to keep buying U.S. Treasury debt. So rates just in the past 2 weeks have crept up higher than they have been in the past for the past year. And I think that's really sort of the market taking a breath and trying to figure out, okay, where do we go from here? So long story short, sorry for rambling, for muni issuers, the short end continues to go up, and it'll keep going up, projected, as the Fed continues to raise rates, which we expect them to do in both December and multiple times next year. The long end has hung in there for now. Maybe that's going up in the future. If I had a crystal ball, I wouldn't be here. So. Okay, page 4. So what we've expected when 2018 started, we knew that supply was going to go down because we lost advancer fundings. Advancer fundings were about a third of the new issue market last year. So we were anticipating, supply is going to be down a third, but also demand would be down because the reduction in the corporate tax rate had lowered the attractiveness of municipal bonds to banks and insurance companies. So as you can see on the top, issuance did go down. We projected it would be down 30% at the beginning of the year. As of now, national volume is down about 17%. New Jersey volume is down 33%. This excludes a large $3 billion transaction for tobacco bonds in New Jersey. That's an outlier. It's not going to happen every year. So to get to a more normal level, we excluded that. So as expected, New Jersey issuance is down a third. In a normal market, when supply is down that dramatically, you would expect, and demand has stayed the same, you would expect prices to go up and your yields to go down. But because it hasn't, demand has been stable, it's not dramatically affecting your rates. The bottom chart on this page is estimated weekly flows of bond funds. And as you can see, after a little bit of blip earlier in the year, it's been largely positive, meaning that individual investors are still interested in tax-exempt bonds, and they're still putting money in muni bond funds. As I said on page 4, demand is stable. That's a little bit of a surprise to us in the muni market because we were expecting a dramatic decrease in rates by decrease in demand from both banks and insurance companies. That has happened, but a surge in demand from retail, high net worth, particularly in states like New Jersey that are high tax states, where people are going to be hit by that state and local tax deduction cap. They're searching for ways to find income tax deductions. So retail and retail-related accounts have driven pricing in a lot of New York, New Jersey bond issuances, particularly in the 1 to 15-year range. Banks and insurance companies, their participation has decreased as we expected. And additionally, the reduction in the corporate rate has wiped out the value of bank-qualified bonds versus non-bank qualified bonds. Scott and different financial advisors look to tell you whether or not to issue your bonds bank qualified. There's usually a curve. There is a curve, a BQ curve versus a non-BQ curve. And in the past, there was dramatic value to issuing BQ. Now there is a 1 basis point pickup in 1 year, and that's it. Otherwise, it's entirely the same. I spoke with our bank qualified underwriter yesterday just to get a feel of who's buying the bonds that he is underwriting, and he says it's only retail and retail-related customers. No banks are buying when he bids on a BQ deal. The story is there's still demand for munis. It's just coming from a different place. When we get to a point where the retail demand is not as great as it has been this calendar year, that's when we could see some action in prices for your both new money and refunding issues.
What we're going to discuss now are the alternatives to be considered for the loss of advancer fundings. To break down this slide and the next slide, these are the alternatives that you'll be considering, but we broke it down with this slide first because these are the more prevalent considerations, while the next slide are less popular ones that we feel that you should still be aware of. Before we get into these alternatives, though, for those that are not familiar, an advance refunding was a refunding that occurred 90 days, or more than 90 days to the call date. So if you had a call date on April 1st, 2019, if you had a refunding that occurred prior to January 1st, 2019, that was an advance refunding. Obviously, the main benefit of an advance refunding was to be able to lock in to interest rates well in advance of the call date. Prior to the tax reform, issuers were able to do one tax-exempt advance refunding per bond series. So with the loss of advance refundings, the first obvious option is to simply wait and execute a current refunding. A current refunding is when an issuer refunds existing debt within 90 days of the call date. So using the same example from before, a current refunding would be a refunding that was executed after January 1st, 2019. Given that current refunding can be done on a tax-exempt basis and occurs close to the call date, an issuer can receive the best benefit to their savings. The biggest drawback, however, is that a current refunding has interest rate risk. Basically, you have to wait until that 90-day window. In addition, the current refunding has a limited time frame. So if you don't execute that refunding in that time period and the call date has elapsed, then the refunding will lose value and the savings will slowly diminish. The next alternative is the taxable advance refunding. The tax reform only eliminated tax-exempt advance refundings. So the benefit of a taxable advance refunding is, again, you can lock in rates ahead of time, well in advance of a current refunding. Taxable bonds have a diverse buyer base and would eliminate the need for tax-exempt compliance. The main consideration when issuing taxable bonds is the higher cost. Obviously, tax-exempt bonds offer issuers the benefit because the investors receive that tax exemption. So when issuing taxable bonds, you have to consider that. Issuers may consider taxable bonds because they expect tax-exempt rates to increase more in the time before the call date. Another downside to taxable bonds is that they have more restrictive and costly redemption features. The make-whole call redemption feature is like it sounds. It makes an investor whole. So while you can refund bonds now, it does come at a cost. Taxable bonds have less of legal limitations than current refundings. As for instance, you don't have to worry about private use issues. One alternative that is becoming more common are forward delivery bonds. Transactions typically price 2 to 4 weeks prior to closing. Forward deliveries, however, can be priced several months in advance. And this allows an issuer to lock in rates much further than a current refunding. However, due to the fact that investors have to wait for the delivery of the bonds, investors demand a forward premium and a liquidity premium that can cost an issuer approximately 4 to 8 basis points per month. So if you price a bond 4 months in advance, you might be looking at a 16 to 32 basis point increase to your bonds. The other drawback to the forward is that the actual window of when we can execute the forward. We've seen in the marketplace forwards get priced about 20 months ahead of closing, but realistically, they occur more 4 to 12 months in advance. Forwards also have a number of legal complexities which include potential outs. These outs might include tax law change or on the state or federal level that affect the tax status of the bonds. The second page also has other alternatives, but these are less common. They are less common. They are being considered and executed, so it's important for you to know about them in case they are presented to you. The forward bond option results in an upfront payment for you, but this comes at the price of letting a dealer have the option to buy bonds from you in the future. So your upfront payment is the savings because these bonds that are being issued will be structured the same as your existing bonds. So the main benefit for them is simply that you can lock in rates in the future. However, there is a clawback provision for these types of bonds, where, for instance, if your rating drops below a minimum threshold, they might require compensation for this. So this money will come from the upfront payment that was given to you, so it is a reduction to your savings.
The difference between the pricing date and the closing date could mean a change in administration or a change in whoever is at the CFO position. So that's something to consider when you're potentially executing either a forward delivery or forward bond option. You could be signing up for something that you won't be there, or a different administration would be there to execute, and they would be locked into that contract. And if they decide not to, there's penalties for pulling out of that contract at that time. So it's just something to consider.
So Cinderella bonds, like the name, are a bit of a fairy tale in the fact that they're issued as taxable, but at some point convert to tax exempt. So an easy way to think of it is a hybrid between a taxable advance refunding and a current refunding. This allows issuers, again, to lock in rates well ahead of time, but the main issue that we see here is that they're very rarely used in the marketplace. We can only really see a couple that have been issued over the last couple of years. So when trying to consider this option, you have to keep in mind that there may not be an investor base looking to purchase. The final alternative I want to talk about is the cash optimization, which is an option for issuers with a large capital program and large amounts of liquid cash. In essence, an issuer would redirect funds it would use for capital projects and use it to refund existing bonds. Then what the issuer would do is finance the capital projects with bonds. So it's a little bit of a misdirection, and one of the major issues that we see is just there could be a legal issue, so obviously we would want you to consult with your bond counsels. The other major drawback is just the fact that you would need to have a large amount of capital projects being done that year, so you can use enough funds to refund the bonds you're looking at. So now I'm going to pass it over to Stephanie to talk about the hypothetical refundings using some of these alternatives.
This is a real-world example of the three options that Scott laid out on the first slide: a tax-exempt current refunding, a tax-exempt forward refunding, and a taxable advance refunding. This assumes a 2010 issue with a call date of January 1st, 2020. So using the tax law requirement that bonds can only be refunded on a tax-exempt basis 90 days prior, we've assumed the current and the forward delivery will be dated and delivered in October of 2019. The taxable bonds, as Scott said, can be issued at any time. So we've assumed, just for clarity, that will also be in 2019, but will be in January of 2019. So it's a market call when you're deciding what to do. If you think rates are going to go up dramatically between now and the time that your debt is currently callable, then you might consider either doing a forward delivery refunding or a taxable advance refunding. The information in the green box is your gross budgetary savings and your PV savings on a scenario like this. Obviously, the current refunding provides the most savings, but that's the market as of today. Who knows where we are going to be in a year? So if you think rates are going to go up, there's a mathematical equation that your financial advisor or your underwriter can do for you to figure out, is it worth taking this risk today? So the bottom line right above the bottom green line is the break-even rate. So a tax-exempt forward, the break-even premium is essentially the premium that you're paying investors for that forward delivery. So we've estimated 6 basis points per month for a forward delivery. So that would be, you're paying an additional 60 basis points on your bonds, which decreases the savings, about $500,000. But if you think rates are going to go up more than 60 basis points by October 2019, maybe you consider doing this now. In the taxable advance refunding scenario, like Scott said, taxable rates are higher. You're going to be paying more because the investors are not going to have the benefit of the tax exemption. That creates, almost $900,000 less in savings. And to make up for that, by the time you get to that current refunding window, that's 105 basis points. So again, do you think rates are going up 105 basis points? Are the additional benefits of taxable bonds versus tax-exempt bonds, do they make that worth it? You don't have to do all your tax-exempt post-issuance compliance. You don't have to worry about private use. Those sort of things can all be taken into account when you're thinking about, which option to go forward.
So we've talked about how tax reform has affected refunding bonds. Let's now move on to see how it can affect new issuances. Historically, tax-exempt bonds are issued with a 10-year par call. So if you have a 2018 issuance, the call date would be 2026. And just for your benefit, the at par portion of the call feature means that when a bond is called, they are redeemed at face value. So now that advance refundings are no longer around, issuers are now considering alternatives to mitigate this loss. The first alternative we would like to discuss is a shorter call. For instance, if you have an 8-year call, if you have an issuance in 2018, you would have callable bonds in 2026. With the ability to call bonds sooner, issuers can generate more savings on a refunding and because they are refunding more bonds over a longer period of time. Before tax reform, shorter calls were done in the market, but weren't done as all that much. But since the tax reform, they have been utilized more and more. Investors have a good understanding and don't need to be well educated on this product. However, the primary concern with shorter calls is that they come at a cost. Stephanie will actually get into more on the next page and how it affects the yield to maturity. So when considering these shorter calls, you need to really weigh the cost and the benefit, and you should do this with your advisors. The other alternative is shorter calls with a declining to par feature. And basically all this is saying is instead of calling bonds at face value, the first year they're eligible to be called, they can be called at 102% of face value. Then the next year it'll be 101, and then 100 thereafter. Compared to the shorter call feature, this would be less costly to you. However, the declining par feature is less common and would require price discovery. When considering shorter call options, issuers should be strategic with how they go about it. In the example on the page, under aligning call features, we have the issuer has callable debt in 2020, 2023, and 2026. So if you're issuing bonds in 2018, and you're considering a 10-year par call, your callable bonds will be in 2028. So in the future, you would have to run refundings for each one of these individually. However, if you issue callable bonds with an 8-year par call, the call date would be 2026. So when 2026 comes around, you would be able to refund two separate series with one refunding. The final alternative is just the taxable make-whole redemption feature. And more or less, it has the same mechanics of a taxable feature and would be very costly to you if you actually were to execute it in the future.
One thing to add to the callable par chart up there is that from an underwriter standpoint and from an investor standpoint, they're more likely to pay attention to a deal if it has a little bit of size. $5 million and under can get lost in the market. You have credit analysts that have piles of offering documents on their desks every Monday morning, and if they see a $4 million GO refunding, they may put it at the bottom. So anything we can do to encourage investors to pay attention to our local transactions is a positive, because the more eyes you have on it, the more demand, and the more demand, the lower your yields. Thinking strategically about placing your calls in the future could, it seems, 8 years from now, who knows what's going to be going on, but it's a good idea to include that as part of your refunding plan and new money plan that you might not have thought about earlier. In the market, in terms of shorter calls versus 10-year calls, when you guys go through a pricing, you generally pay attention to the yield to call. That's what's on the cover of the OS. That's what's on the pricing wire. So investors are purchasing short calls and 8, 9, and 10-year calls at the same yield to call. So right now, it looks like it's the same price. If you anticipate being able to refund those bonds as soon as the call date hits, then you take that shorter call and you run with it. If you think there's a chance that you'll get to 8 years and you won't be able to refund it, as you tick past 8, then 9, then 10 years, your yield to call goes up, and that's what we call the yield to maturity. So when you're pricing out what kind of call you want to do on your new money or refunding bonds, you just want to make sure you're evaluating the additional refunding flexibility that you've been given with that shorter call versus the cost should you not refund those. And again, that's something that underwriters and financial advisors can provide you with the information so that you're making what you believe to be the correct call. Who buys short calls? It's the same situation as who buys 10-year calls, money managers, bond funds. In terms of the BQ market, if banks ever do come back, I've heard from our desk that banks don't really like short calls. They have a set of parameters that they've been given by their boards or governing bodies that says you can buy whatever you want as long as it's A-rated or higher, a certain duration, and a certain call price or call date. So in order for them to go shorter, they have to go back and get that approval. So they generally look for calls between 8 and 12 years. Your cohorts over in Pennsylvania, they've been selling bank qualified bonds with 5-year calls for years. I don't really know how long before I started, I guess. But they have generally paid up for that flexibility. So it all shorter than 8 years, you're probably going to pay for it. 8 years or longer, you could probably get away with it with no change. So we're just going to talk a little bit about what are the strategies you can do with your new money bonds going forward, and bands versus bonds and all that, and I'll let Scott get into it. This is just another example or another chart showing the MMD rates historically. The vertical blue lines are the range from high to low since 1993, and the red line is the dark blue line is the average since 1993. So you can see we're well below the average on the long end. We're just below the average on the short end. So your bands are getting more and more expensive, and your bonds are basically staying the same.
So the current yield curve that we have right now it's a relatively flat curve. And what we basically mean by this is the difference between the 1-year and the 30-year. And the smaller that difference, the flatter the curve, the bigger the difference, the steeper the curve. As you can see, that currently we have a yield curve that's about 137 basis points is how steep it is. To give you a little context, over historic rates over a 10-year period, the average is about 250 basis points. So it's about twice as much. And as you can see, in 2010, it was the steepness of the curve was about 394 basis points. So to put it another way, long-term rates are cheap compared to short-term rates. So what does this mean for issuers? Well, given that we're in a low interest rate environment with a flat yield curve, we would recommend folks to issue long-term debt. Now, there are a lot of New Jersey issuers that regularly issue bond anticipation notes. Just a few years ago, bands were earning anywhere from 25 to 40 basis points. You issue this year, you're probably getting around 150, 170 basis points. In that same time frame, long-term rates have remained roughly the same. So what we would recommend is to issue longer-term rates. And on this final slide, we just wanted to talk about interest rate forecast. This forecast is taken from the Bloomberg Bond Yield Forecast, which surveys a number of firms to get their expectations of different maturity rates. So they're looking at the federal funds rate, the 10-year rate, and the 30 rate. And over the next 2-year period, what they are projecting is that the federal funds rate, which is the rate that the Fed targets, which is the one that increased today, it's going to go up another 75 basis points. In the same time period, they're anticipating that the 30-year rate is only going to go up 50 basis points. So basically what this means is the yield curve, which is flat now, they're expecting to get even flatter. So again, what we're really encouraging folks to do in the time frame is to consider long-term debt and take advantage of these short long-term rates, or of the lower long-term rates. And that pretty much concludes where we're at.